Welcome everybody to this new video. In my background I got the multiplication tables and the periodic table of the elements. We're going to look at multiplying our money via dividends and dividend growth. Let's get to it. Forgot to mention the power of the unicorn. It's going to help us with this video. So this video is on a new purchase that we made, and that is Mastercard. I think you guys probably know Mastercard. They are one of the main credit card companies. They pretty much have a duopoly between Mastercard and Visa, and they're pretty much controlling the credit card space here. Discover and American Express are two players there. They're a little bit more of a risky play, but something to consider. The reason why I got Mastercard is for its dividend, and it is not its current dividends. Current dividend is actually relatively like very low. It's only 0.54% dividend yield. However, the metrics that I really like are the payout ratio. That's how much they're paying back to investors in dividends compared to the total earnings is extremely low at 24%. Many companies will put payout ratios between 40 to 70%, even big companies. The growth rate, 9 years of growth, 5-year growth rate's 25%, which is insane. Last year's a 32% growth, 3 years, 20%. Last 5 years, 24.5%, and 10 years is 36% growth rate. They've been increasing their dividends dramatically in the last 10 years. If you look at it on the growth history, starting as an IPO in 2006, only 5 cents a share per quarter, or else per year, 6 cents per year. And now we are at $1.32 a year. So since they're a dividend growth company, they've been increasing their dividends a lot, but the share price has also been increasing a lot as well. If you go to the Seeking Alpha Momentum tab, you'll see the price performance. So price performance of 1 year, 3 months less 24%. Price return over 3 years was 137%. 200% in 5 years, more than doubled your money, and 10 years, 1,268%. The stock price has been increasing very dramatically. And the dividends have been increasing dramatically as well, but the actual capital appreciation and capital gains of the share price have been increasing faster than the dividend growth as well. So this is a purchase that I'm not necessarily making for current income. I'm going to get very little money on it because it's only $1.60 per share per year. But if the company continues to grow its dividend, even in numbers relatively close to that, these dividend payments will be enormous in many years' time. So if you just go to MoneyChimp, compound interest calculator, let's say we're starting with $1.60 per share in dividends. In 10 years, we're going to have it grow 20% per year. Just the dividends, not the share price, will be up to $49.84 in 10 years. Now, 20% dividend growth rate is pretty hard to sustain. Mastercard's been doing it the last 10 years. Probably more reasonable might be 10 to 15%, especially since the payout ratio is so low. We're still looking at $37.36 per year. And that is just on current dividends that you buy. The yield on cost is a measurement of if you bought the stock at a certain price, what would the yield be later on. 5-year your yield on cost is 1.67%. So nothing super dramatic here, but the share price hasn't been increasing so much. Remember, 1,000% the last 10 years. The shares are going to be worth a lot more over time if it continues doing this in the future. Okay. Here's the number values of the dividend growths. So this quarter, if you want to get in on the stock by July 8th, you buy it the day before for the ex-dividend day, so July 7th, it'll be 40 cents a share in dividends that you buy. Remember, the share price is very high at $2.94. So 40 cents per share that you buy. Let's just look 2 years ago, 2018 at this time. it paid 25 cents. Do 0.25 minus 40 divided by 0.25. It's already grown very dramatically, almost 60% in its dividend in just the last 2 years. Okay. Then you look at 2015, for instance, it was only paying 16 cents a share, 11 cents a share, and so on. I always like to go through the investor relations through the website of the company. This is the earnings presentation that they have from the investor relations. I just want to go over some general ideas here. Net revenue has increased even in the middle of the pandemic from 4,009 million compared to 3,889 million last year. Operating margins are still very good at 53%. Net income slightly higher than before, and they increased their earnings per share from last year by 5 cents. Here's a worldwide growth. Grew 8% worldwide. Obviously, a lot of countries, especially like third world countries, don't necessarily use a lot of credit cards. So that is a growth prospect here. United States still showing growth at 6%. These are in billions of dollars. Last year, 451 billion. This year, 478 billion. Rest of the world growth, looking at another 50 or 60, 50 billion or so. Transactions, they're increasing their transactions from 19.2 billion to 22.1 billion in just 1 year. They are showing a growth in the number of cards as well. Revenue numbers, again, orange is 19, purple is 20. Domestic assessments increased, pretty much similar in the volume fees. Transaction processing, where they make a large amount of their money, has increased by almost 100, and that's in millions of dollars, so $100 million more. Other revenues have increasing too. They're going more into the technology sector and looking for different payment processing. And their total net revenue again increased. Expenses are slightly higher as before, but what's interesting about this company is the net expenses compared to their profits is pretty low. Administrative expenses have increased a bit. It's made it a little bit higher in expenses. However, the earnings increased more than the expenses did. Goals to have a strong balance sheet like they've had for pretty much ever. Invest in strategy-led organic and inorganic opportunities. Return excess capital to shareholders. They have a bias towards share repurchases instead of dividends. For share repurchases is if they have extra money, they could either give it back as a dividend to the investors, or they could buy back more shares, which means that your shares are less diluted in value. Imagine if you had 100 shares out of 10 million, but then the 10 million was bought back by the same company to 1 million. Suddenly your shares is a bigger percentage of the company. Then looking at year-over-year growth, a lot of these numbers have been showing the switch volume because they're going more into overseas. Cross-border volume trends. Card not present, non-T&E has actually been increasing. This is where they're trying to get more into the tech center where you don't have to have your actual credit or debit card in order to pay for it. And non-GAAP is a little more complicated than what you need to worry about. So again, Mastercard, I did buy a small position, only 2 shares so far. So $294, so it was about $600 purchase. I'm going to try to enter around 3 to 5% of my portfolio value, possibly by the end of the year, if the share price stays relatively low. I'm also looking at Visa. Visa does have a lot of similar properties to Mastercard. Share price is also very high, but their dividend history and dividend growth looks very good as well. You can see on July 15th, 12 cents a quarter, and now they're paying 30 cents a quarter. Dividend growth also looks incredible, 19% last year, 25% in 10 years. So there's a chance that I might equal weight Visa, Mastercard, and if I do so, I'll do a separate video on Visa. If you have any questions, feel free to let me know. As always, smash that like button, subscribe, all that great stuff, and I'll see you guys next time.